Welcome to this week's Market Intelligence Report on Biofuels. I'm George Morris, and I have the rest of the team here, our senior analysts, John Cusick, Tori Alden, and Ryan Standard. And we're going to go over the MI report for you this week. If you have questions while we're going through and doing our presentation, please drop them in the Q&A section in the webinar, and we'll get back to your questions when we're done presenting on all three analysts. With that, Cusick, can you start us off and tell us what's going on this week?
Yeah. Good afternoon, everybody, and getting into another week in the Market Intelligence Report. We've got some great information this week on the WASDE report that came in, and Tori Alden will be jumping in on that, as well as Ryan Standard touching on the low CI feedstocks. To get into the sort of biofuels world, the biomass-based diesel, we'll jump into just a little bit of the headline news. On the feedstock side, we saw a joint venture announced between Tyson and Jacob Stern. There had been long rumors around various parties looking to acquire Jacob Stern, as that has become a very strategic low CI feedstock terminal throughout the past years, especially for renewable diesel producers. And so not really a surprise to see an organization like Tyson that's got low CI feedstock origination sort of matching up with what I would call terminal and logistics, and even a pre-treatment provider like Jacob Stern. And we'll expect to see more of these type of partnerships and ventures in the coming years that are going to be filling that void between especially the lowest CI feedstock origination and then the refining of those products to meet the sort of new quality specifications that are coming to market from these renewable diesel projects and co-processing projects that are being announced. So expect to see more of these type of JVs in the future for certain. On the markets-wise, we had a great, good week. RIN markets rallying a little bit. On the D4 RIN, moving forward, inching up a little bit on all three vintages across. We're still seeing that backwardation between the 2019 vintage and the 2020, the B20, with that B19 trading about 4 or 5 pennies higher up front. This continues to be something we have seen in past years, in which the demand nearby for that B19 to fill out your sort of yearly compliance accounting, if you will, sort of spikes that vintage above the others, whereas normally we see a bit more contango to that curve across the vintages. So we expect, like we saw even with the B18, that B19 demand to stay strong here right up and through the end of February, to where obligated parties are actually handing in those RINs for compliance. And obviously the 18 and 19 vintages are what are going into the box here shortly. And we'll see that sort of straighten out with the 20s. That is the B20 2020 vintage here, again, probably in the next week or two. But overall, we see that sort of RIN complex continuing to inch higher. There was some headwinds against it with the HOBO towards the second half of last week. And I think those supply and demand fundamentals, the fact that the D4 RINs continued to inch higher, even arguably against a HOBO spread that was moving shortly against that direction in the second half of last week, shows those underlying fundamentals that we've been talking about and Tori's been pointing to, where we think again in this sort of Jan, Feb, and even a bit into March, that the remnants of that BTC situation last Q4 still leaving some scars, especially on the biodiesel market. So then getting a little bit into the biomass-based diesel markets, we're seeing those markets start to sort of assimilate into the 2020 trading with the different pieces of that structure in place, namely that BTC. It always takes a month or two as these markets sort of transition, especially with biodiesel, as renewable diesel is a bit more locked into that California demand at the moment. But regionally throughout the U.S., we're seeing biodiesel markets sort of assimilate back into their pockets. we've got kind of Midwest markets trading, with the RINs at origin as a B90 at about heating oil plus 35 cents. That gets you to that sort of RINless discretionary blending level of about a heating oil minus 39 or 40. So pretty good blend margin back into the market. Houston's obviously a little bit less, probably heating oil plus about 44 cents. And then that gets you closer to about heating oil minus 35 down there. And then New York Harbor continues to be a little bit tighter, not as much volume up there, probably closer to a minus 30. Producers even asking minus 25 in those markets. So we're seeing those markets sort of assimilate back. And then the West Coast market's the one that everybody's following. And a lot of biodiesel continues to move into that market. The steep discounts in the neighborhood of $1, $1.10 remain consistent in both the Northern California and Southern California markets. While on the renewable diesel, that material continues to carry full value for the producers, and thus no discounts are required to move that volume, or that product at the rack. So the main differences then in that California are the way each of the different gallons are being discounted at the rack against the carb diesel number. Renewable diesel in very high demand and clearly in lower supply as the producer capturing the lion's share of all that margin at the rack. While in the biodiesel, although they're capturing the credit values, they're ultimately having to give a lot up in the discount against carb diesel. Again, close to $1, $1.10 below the price of carb diesel in that market. And that continues to set a lot of the pace for the things we're seeing into the West Coast and the Western demand that's starting to come out. The feedstock markets, certainly through the string of announcements we continue to see, and how that Western North American market continues to become very interesting, not only from a fuel demand, renewable fuel demand, but future feedstock demand. And I think with that, I'll pass over to Tori.
Thanks, John. So what I'll cover is we got both the WASDE report just shortly before the beginning of this webinar, and we also got data from the Malaysian Palm Oil Board this week. I'll start with the USDA report. As expected, USDA raised its forecast for U.S. soybean oil exports, given where we've seen commitments so far this year and how much they're running above where they were last year. USDA had been forecasting exports well below last year, and so it became kind of obvious that they were going to need to raise their forecast for 1920 exports this year. The big question was, what would they do to offset that increase, or would they just let that increase fall to ending stocks and lower ending stocks? And what they ended up doing is more than offsetting the increase. So they also reduced their forecast for soybean oil usage and biomass-based diesel production by 300 million pounds, which brought their forecast closer to ours, which is at 1.81 or 1.18 million, 8.18, billion pounds. And they also reduced non-biodiesel usage, which in the way that they calculate it includes renewable diesel. I wouldn't be surprised if the 100 million pounds they took out of non-biodiesel usage was as a result of a reduction in their forecast for non-biodiesel or for renewable diesel usage. That all reduced demand by 200 million pounds to 25 billion even, which again is basically in line with where we were at 24.95 billion pounds. The other change that they made to their balance sheet forecast was a decrease in production. They didn't change the crush, so this is actually a decrease in the soybean oil yield. They reduced output by 130 million pounds, 24.29, which is just below where we are now at 24.32 or 34. That raised ending stocks to just over 1.5 billion pounds, which is in the right direction, but still just under where we are at 1.56. As a result of the increase in ending stocks, they lowered their forecast for the Decatur price from 34 cents to 33.5 cents, which took it just a tenth of a cent under our forecast of 33.6 cents. For palm oil, the palm oil data was generally as expected. There were a couple of little surprises. Production came in a little bit lower than analysts had expected. It came in close to the lower end of the range of analysts' expectations. But outside of that, exports and ending stocks were both generally in line with analysts' expectations. Ending stocks came in a little bit above where we were projecting because we had forecast a smaller decline in exports than the MPOB reported. However, that really wasn't the big news that has moved the market and has pressured palm oil prices over the last 2 days. They've dropped 2% each day. The big news that really drove that move was a decrease in cargo surveyor data, which indicated that palm oil shipments during the first 10 days of February fell about 20% or more from the first 10 days in January. This time of the year, palm oil exports typically slow down, but that decrease was about double the average rate that you see for a drop in February. And with the coronavirus and the tensions with India, traders are really nervous about the pace of palm oil shipments going forward. With that, I'll toss it back to George.
All right, thanks, Tori. And for the attendees, if you have any questions, go ahead and submit them in the Q&A section, and we'll get to them as soon as Ryan's finished his portion of the presentation. Ryan, let's go back to you and go over the low CI feedstocks.
All right, so this week we're focusing on the choice white grease market. We still feel that there's room on the upside for the white grease market, and the reason for that is overall snugness in the entire low CI complex. There is the potential, or there is risk in the market for lower prices based on corn values. Corn was off a little bit this morning after the USDA report. And as I indicate in the commentary this week, if you see corn fall into a 350 to 360 range, there is potential for nutritionists to kick choice white grease out of rations and include more corn. But as I said, the market's really snug. BFT is seeing strong nearby demand, and there's just not a lot of options for the feeders as well as the fuel producers after low CI feedstocks. So I think we'll continue to see strong prices there, and we're predicting that to trend upward over the next couple of months as people continue to reach for feedstock. We're hearing prices into the Gulf as high as 33.5 cents delivered, which is a premium well over what Chicago's currently paying. So there's sellers have a lot of optionality right now. The buyers do not, and in a nutshell, that's why we are forecasting a strong market. Pretty succinct this week, George. Back to you. And
all right. Well, Ryan, we'll go right back to you because we got a question here. Can you give us an update on what's going on in China and how that affects the market? I feel like this will be a continual update for you until this thing pans out.
Yeah, that's a good question. As far as white grease goes specifically, I don't think it's going to have a tremendous impact directly on price, but we could see, hog slaughter is forecast to slow down over the next 6 weeks, so that's going to tighten up production a little bit. If the logistical hurdles continue for people moving pork or other materials into China, containers coming back, etc., then we might see hog production slow a little bit more than what was originally forecast at the beginning of the year, as there's just not the logistical capabilities to get all that pork to China. Storage starts to back up, and numbers come off, producers I think will start to slow even more. So there is, I say, the asymmetry and the risk is for tighter production versus more production in the near term, which is also supportive of higher prices.
All right, thank you, Ryan. Tori, question for you. When does the palm oil output start to recover from the impact of the droughts last year?
So it may be starting already. Typically, you see the seasonal bottom in palm oil output occur in January. If you look at the daily average output in February is relatively flat with January. Obviously, February is a shorter month, so total output still continues to decline. But on an apples to apples comparison, you start to see that turn in February. And one of the big questions this year is when will we go from sort of below trend output to above trend output? Last night or on Tuesday in Malaysia, there was a report from one of the Millers Associations that suggested that output during the first 10 days of the month was 48% above the same period in January. That's about double what we're projecting, and if that continues, that would strongly suggest that that we've probably hit that spot. Our forecast takes us basically back to trend line. So if that continues over the balance of the month, I think we can say that in February we're going to start to see that recovery. And just as a reminder, one of the best ways to get a fruit-bearing tree to produce a lot of fruit is to stress it and then give it really good conditions. Right now, in fact, I've got some tomato plants on my lanai, and some of them went through some stress, and one of them didn't. The one that didn't is like this huge big plant that looks really pretty, doesn't have a single tomato on it. The two that got stressed are these tiny little scraggly looking things just chock full of tomatoes. It's the same kind of thing with palm oil. So once we do start to see that recovery, we think that we probably go above trend line, and that in part is also contributing to the weakness in palm oil prices. The question is just how quickly does it come back, and how much above trend line does it go once it does come back?
All right, thank you, Tori. I want a BLT now. Thanks. Cusick, question for you. We'll go over to you on this one. Has the BTC been assimilated into the physical markets?
That's yeah, common question that we're getting at the Jacobson. People trying to track how that is assimilating in, and I think the reality is because the tax credit was lapsed for a couple years, what you had was this sort of negotiation on a sharing of the tax.
Hey, John, can you speak up just a little bit?
Yeah, apologies. So I think what the question's referring to is how this tax credit is assimilated into the market. We've had some questions over this, and with the tax credit lapsed in the past 2 years, we've had the tax credit theoretically being negotiated and percentages of it. So with the tax credit in place, what we're now seeing is pretty much a all or nothing, which is either a B100 market, which is you're selling the biodiesel with the ability to get the dollar per gallon credit, so a B100 transaction. So theoretically, $1 higher. Then there's the B99 transaction, $1 lower. Tax credit is already being taken by the producer. So whereas we used to have percentages, 50-50, 25-75, now it's sort of all or nothing, B99 or B100. For the most part, there's $1 there, but we'll get into the details on that some more in the future MI reports.
All right, and John, I'm going to stick with you. On the D4 RIN, the B19 over the B20, you described as backwardation. Can you explain that a little bit more?
Yeah, so I touched a bit on that on covering the RIN market. So, you know, when you see a series of time, and it's normally with futures contracts in months, you know, January, February, March, and that forward curve is either going up or down. When it's climbing, it's in contango. When it's decreasing, it's in backwardation. So people have asked, why is the B20 RIN trading below the B19? And that is a form of backwardation. It's by year. And that's usually a product of something that happens around the year-ending accounting in the RIN market. Why backwardation and contango happens in other markets, there's a variety of reasons. But in this particular case in the RINs, it's more of an anomaly with the year-end accounting of handing the actual B19 and B18 RINs in. So that backwardation we expect to sort of revert back to contango where the RIN markets generally sit for most of the year.
All right, thanks, John. We have one more question. If anybody has additional questions, please go ahead and submit them. Tori, this one goes back to you. Does the change in the USDA projection for biomass-based diesel demand for soybean oil have an impact on your balance sheet?
No, like I said, it brings their forecast closer into line with our forecast. I think the big question in the market in what prices are trying to grapple with, and why you've seen so much volatility in the futures market over the last month or so, not only was the run up to the BTC restoration, but also then the collapse after that, because there hasn't really been that physical demand. And I think the big question is, when does that physical demand kind of come back? USDA's move today brings their forecast into line with ours, but if the physical demand doesn't come back, ours may ultimately come down a little bit more. We think that it is going to come back at some point. It's just a question of, does it come back in February? Does it come back in March, April? I think it's probably sooner rather than later. And if that's the case, then I think our forecast is fine. And I think USDA is probably going to be pretty happy with where their forecast is. But if we keep seeing a delay, and the way that you know that, if you aren't somebody that talks to people in this market all the time, the way that you'll see that is you'll see that the futures price remain relatively weak, because what we've seen through this big collapse, one of the most interesting parts about it is that the funds really haven't been sellers, at least not in their long oil share position. Their long oil share position has stayed relatively stable, close to the highs. So there aren't a lot of natural sellers, and I think almost any physical demand that comes at the market is probably going to raise prices. So to the extent that you see prices at current levels a little bit weaker, maybe even a little bit higher, you know that demand hasn't started to come back yet. When you see prices start to rise pretty steadily, I think that's when we're gonna know when it comes back. And at that point, then I think we'll be able to really kind of zero in on where we're going to be this year. Again, if that happens soon, I think we're probably pretty close to where we're going to be this year. If that doesn't happen until April or something, which I don't think there's any reason for that to happen, but just say it were to happen, then I think both USDA and the Jacobson would be taking their forecast down.
All right. Well, thank you guys for taking the time to answer those questions. There's no more questions from the audience here, so we're going to go ahead and wrap up. We'll be sending out a recording of the webinar here in the next hour or two. And please join us next week and send any questions that you have over to myself, or submit them through our web form, and we'll be happy to answer them next week.